What's going on, everybody? We are live for the market close on Monday, November 3rd. Let me know in the chat if you can see me and hear me all right. I want to make sure everything's working. Okay. Oh, you said no. You cannot see me or hear me. Is it the audio or is it the... Oh, everybody else is saying perfect. Maybe turn your volume up, KV95. All right. All right. Good to go. Seems like you guys like me, like when I do the live streams here, so I'm going to try and do them more and more often. Timing wise, just works out best to do these for the market close. We can talk about anything that's been going on during the day, any news that's been moving the markets, and we can look at some different stocks or tickers as well that have had some big moves during the day. And I will answer as many of the questions that I see come in through the chat, if you guys throw them in there. And apologies for the audio if you do hear any jackhammering or drills or saws or nail guns in a bit of a construction zone right now. So I think I've got my microphone dialed in. You shouldn't hear too much interference there, but just in case. Okay. First question I saw come in was on Palantir. So Palantir lost a lot of money on buying puts on Palantir over the last, I don't know, year or so. Let's see if we can pull up the chart here. All right, we'll share. Let's do share screen, share window. Yeah, let me move that. Let me pull up my charts. There we go. And then pay those profits out as dividends, and assuming those profits don't change. It would take 646 years for you to get back the price per share that you are getting. So valuation, the like, really what you're doing is anytime you're trying to do any fundamental analysis on a company, you're just trying to decide how much should I be paying for a money printer, because that's all businesses are. Their assets, they're money printers. And so you might be willing to pay a lot of money for a money printer, even if it doesn't print out any money right now, but you have, a good reason to believe that in the future it will print out a good amount of money. You may be willing to pay only a small amount for a money printer that currently pays out a lot, that currently prints out a lot of money, but it's constantly breaking. It's very old, and you think it might not last that long before it stops printing money. That's all valuation is. And so, price to earnings ratio is like, okay, well, let's say all of the money that it prints, it stops reinvesting to try and grow the amount of money that it prints, and it just pays that out. Well, it's going to take you 646 years before you get back your initial investment of $206 per share. So it's just insane to me how people are paying for this. Obviously, I've been wrong about that. And so, the markets can remain irrational longer than you can remain solvent. That's the only smart thing that John Maynard Keynes ever said. And I think that it's very true. That's why I don't like shorting, because when you short, then you open yourself up to unlimited risk, because you have to borrow the shares and sell them. In order to close out that trade, you have to buy the shares back to deliver them to whoever you borrowed them from. That's how a short works. And so the shares could go up an unlimited amount, which means you could have an unlimited amount of loss, like more than your account value. Ultimately, you'd get closed out before that unless the move happens too quick. But that's the reason why I don't like shorting. And so the name of the game is always risk management. That's why the best investors and traders throughout history always say that the number one rule is to not lose money. That's Warren Buffett's, and he says number two rule is never forget rule number one. But every one of the best investors and traders throughout history has their own version of that saying, like, always take care of your losses, and then your profits will take care of you. Risk management is key. Risk mitigation is key. Like it's all the exact same thing. And so if you take out a very small, like if you open up a small long put, then one way you're managing your risk there is through position sizing. If the trade doesn't work out, then it doesn't impact your portfolio. But if it does work out, then it does impact your portfolio. So no matter how you manage risk, the goal is always to make sure that there's asymmetry there, that whether you're using stops or you're using options, whether you're hedging, whether you're doing with it position sizing, or whether you're looking at fundamentals, looking for the margin of safety, however you are managing risk, you're doing so in a way that your potential reward is greater than what you're risking. Um, okay, let's see. Is Tesla making big moves today? Let's pull that up. Well, Tesla's up. Okay, so technically speaking, I've been in Tesla since it was right. It was either right here, June of 2024, or is it right here in August of 2024? It was somewhere in here because I saw this wedge. Looked like it was about to break out. And this looks very bullish, especially after this the crash that happened here when all the political stuff was happening and the political breakups that Elon was going through. Um, and then this is another bullish setup, another bullish triangle setup here. We got a nice breakout, and now we're retesting against resistance here, which I believe was all-time high back here. No, we're a little bit above that. All right, so we've been consolidating above the previous all-time high as support. Establishing this new trading range here, and we've got this double top going on right here, maybe triple top. I'm not I'm not one to put too much weight in whether double or triple tops or bottoms are bullish or bearish. They're essentially just testing support and resistance. And so if we get a breakthrough and then a fallback down, retest that old resistance as new support, confirming that it holds in a bounce, then it's off to the races. I think we could hit 700 super quick, but that's only after a breakthrough. I would not be entering a new position until a breakthrough gets confirmed. If I didn't already have a position here, I think there's very good chance that we have more volatility in here between the 410 and 400 $70 range here. But a lot of it also depends. Did they come out with the earning? No, they already did. A lot of it also depends on their future announcements. Like they might have a Tesla Roadster announcement by the end of the year or early next year. Optimus robot, that kind of thing. Robo taxi fleet. All of those investors are paying. This is another one. The price to earnings ratio is 300. So it's like clearly investors are paying for the chance that in the future, this company will be extremely profitable relative to their price. And investors understand that it's not true right now. So, all right, let's see here. Building your new ballroom edition. Yeah. Building my new ballroom. Definitely. All right, let's see here. All right, throw in your questions if you have any questions about the market. If you guys didn't see my recent video on Friday, the big news right now that I think is most important to pay attention to is that the Federal Reserve has announced an end to quantitative tightening, which means their balance sheet will remain the same level. So when balance sheet is dropping, that means they are withdrawing liquidity from the system. There are other ways that liquidity can be increased, but the Fed's actions on the market are withdrawing liquidity. They've been doing that for a couple of years now. They brought the extra reserves from the repo facility down to basically zero, and so now they're like, hey, we don't want to get too tight. We want liquidity to what they call they want an ample reserves environment. Which they say, okay, we're basically there now. So they're ending QT, which means any of the debt that gets paid back to them on their balance sheet, they just take that cash and they roll it back over and buy new debt with it. But the thing is here that most people are not talking about is in their implementation notes, they say they're actually going to still wind down the balance of their mortgage-backed securities, and then they're going to take the extra from that and reinvest that in treasury bills. And so, yes, the balance sheet is staying the same, but more and more of it's going to be made up with T-bills, less and less of it with mortgages. And so they're able to effectively do QE for the government on the short term for liquidity purposes with T-bills, and it's being funded by lack of liquidity in the mortgage space. So that's going to be a headwind for for anybody expecting mortgage rates to come down. Obviously, the Fed is not the only player here, but that's definitely going to be a headwind there. So we're going to see more and more liquidity driven decisions by the Fed because the government is running a 2 trillion plus deficit every single year, and you just cannot continue to tighten once you've drained all the extra reserves in an environment like that. All right, let's see here. Question. MicroStrategy. Let's pull up a chart from MicroStrategy. MicroStrategy. This is a, let's see, what's their market cap right now? 75 billion. Bitcoin's at 106. So I think they're pretty close to their net asset value now. When you look at the number of Bitcoin that they have on their balance sheet, I'm pretty sure their market cap is pretty close now based on the price of Bitcoin. Correct me in the comments if I'm wrong, but I think they have about somewhere between 70 and 75 billion dollars worth of Bitcoin at this time. And so what Michael Saylor has promised he would do and continues to do and follows through on is that he will sell shares and create new shares to sell them if the share price is, if the net asset value of the company is above or the share price is above the net asset value. It's like the market is giving him a premium, so he's going to sell into that because the shares are worth more. He can sell them for more than they're actually worth. And from my understanding, he will not be doing that if the share price drops below fair value. And I think he's stated in the past that he might even buy shares back if that happens, because then they're basically getting them at a discount. You'd have to borrow in order to do that because he's not going to sell Bitcoin. And at this current time, I don't think the borrowing is an issue, but it could get to the point where that's not possible. But anyway, so I think right now around this $240 to $270 range for MicroStrategy is assuming Bitcoin stays above 100,000. Assuming Bitcoin stays above 100,000, I think this range for MicroStrategy is probably the bottom. I don't see the market really being able to push it much lower because then the shares are trading below their the company is trading below the value of the actual Bitcoin that it holds. Last time that happened was right here. February 2024 was the last time that MicroStrategy was trading at a price where it was worth less or the same as the Bitcoin that it held. Now, there was a giant short interest on MicroStrategy at that time. I don't know what the short interest is on MicroStrategy right now. I don't think it's super high. It might be. I guess could be set up for a squeeze, but that would require the price of Bitcoin to really start taking off. And so far, we're just in this correction phase here. So I wouldn't expect MicroStrategy to take off without Bitcoin taking off. Michael Saylor is just going to sell into that. Okay. Let's see. Question. The picture in the back, for any of you who are not, who didn't see that video, the picture is the Monopoly Man and Scrooge McDuck, and they are playing poker together. And you can see they're playing with bars of gold, with cash. Scrooge McDuck has a little Bitcoin pin on his vest. And so it's a custom piece from this girl out in Russia. Her name is Daria Kolosova or something like that. And this one is called Capitalism. Basically represents a couple of things. Number one, in order to make money, you have to take risks. So that's what the poker piece represents, why they're playing poker. Monopoly is, when you're building a business, you want to, through free market forces as much as possible, have a monopoly in the, product or service that you're selling, so people come to you instead of anybody else. You need to acquire assets, the cash flow, use debt judiciously, So there's a lot of good principles in monopoly. So that's why the monopoly man is there. He represents a lot of good a lot of good habits to build for building wealth. Scrooge McDuck, because a lot of people demonize him, or Ebenezer Scrooge. But in reality, the miser is a hero in free markets because they provide a service or a product and save the money without ever spending it, which means that essentially, while they're saving, they're providing for free. They're never turning in their IOUs, their money, for real wealth. And so prices would be a lot higher if the miser would spend all their money driving the prices back up for all the money that they withdrawn from the system. Um, and so the miser performs a service for society, basically providing products or services without ever exchanging that for real wealth, leaving everybody else better off. Um, and then obviously they're using different forms of money. So anyway, lots of little things that I had built into that, that I like for businesses and building wealth and investing. All right, let's see here. Question. Any thoughts on what is happening in the repo market? So, talking about this, I touched on this just a tad bit when I was talking about what's going on with the Federal Reserve right now, but that's one of the reasons why they are ending QT. So, the repo market is where banks go to get overnight funding from each other, and when cash is abundant in the system, they need collateral. And so, for years, like from 2021 through 2022, 2023, that was the situation. There were way too many deposits. They needed collateral. Rates could have been driven negative from that, and so the Fed said, "No, come to us to get that." So all the extra deposits went into the reverse repo facility at the Fed, and they got their collateral there. They got paid an interest rate, risk free, from the Fed for doing that. And so for the last couple of years now, the Fed has been drawing down liquidity out of the system through quantitative tightening in order to get reserve balances between bank reserves and repo down to what they call ample instead of abundant or excessive. That's to zero now. And so the regular repo facility at the Fed has started to get used more and more now. And that's because liquidity is now down to like a, I guess, somewhat normal level. And so there are small situations here and there where banks, they're, on net across the board, it's not like everybody has a ton of cash and needs collateral. There's some banks that need cash now. And so in order to make sure that that repo rate doesn't spike, which is what caused, Lehman Brothers to fail and could have caused all the banks to fail, is because, nobody had cash, they all had bad collateral. Um, so in order to prevent that from happening, the Fed also has a regular repo facility. So if banks can't access cash from each other, then they just turn to the Fed and use the Fed's repo facility to get that cash. And that's been happening more and more. Nowhere near like the repo madness of like the end of 2019, but it is a sign that reserves are like the liquidity in the system is tight right now. Not anywhere where it'd be like dangerous of like, banks like, being ready to collapse or fall over overnight. But it is a sign that things are like would potentially be headed in that direction if the Fed didn't stop QT, which is why they just announced that they're stopping QT. So I don't think that we are going to see any sort of bank failures, anything like that, like Silicon Valley Bank type of thing, especially because we are in a environment where the Fed is lowering interest rates now instead of hiking, and it's expected versus those hikes were largely unexpected by financial institutions. At least they were unexpected at the time when they bought up all those long bonds at zero rates. So anyway, short answer is I don't expect any crazy liquidity things happening because the Fed is very scared of repeating mistakes that it's made in the past. Um, and the repo madness of 2019 is one of those mistakes, and it's still Powell. So I see them erring on the side of caution first, which means if anything, they'll start actually expanding their balance sheet again, rather than just keeping it steady if the repo facility starts getting used more and more. What do you think the probability is that Bitcoin goes lower than $100,000? I mean, I don't know, 40%. I don't know. I don't think there's anything magical about that number. It's just a matter of how many people are taking profits, and are they willing to accept lower and lower prices to get out? And are there too many people that want to buy that are going to soak up all that selling and be willing to buy at higher and higher prices? Long term, I'm very bullish on Bitcoin. Short term, I have absolutely no idea what it will do. Like there's, I'm not trading it. I have no conviction one way or the other, and I don't care at all. Um, if you don't have any Bitcoin, I always say, a 5% allocation is a good place to start. And then of all the money that you invest, 5% allocation, dollar cost averaging into it is a good place as well. And then if it goes to zero, the most you've lost is 5%, which means your portfolio goes from 100% down to 95%. If it becomes money in the future, then you've secured a good amount of wealth for yourself. Is that a Klipsch speaker? Yes, that is an old Klipsch heritage speaker. Um, there was a like 2019, I think maybe like into 2020, they were redoing all of their designs, and all of their stuff used to look like super old school vintage like that. Most of their new stuff doesn't really look like that anymore. So I got a couple things from them. I like that old school vintage style of um, just stuff in general. But it doesn't work anymore. So it's literally just a giant paperweight. I don't know what's wrong with it, but yeah, it doesn't work anymore. But it looks cool. All right, let's see here from El Diaz. Thank you so much for the super chat there. I believe it's called a super chat. Appreciate it. Thoughts on what markets will do once the shutdown ends? Markets are future discounting machines. They're so basically the more likely something is to happen in the future, the more that is already priced into the present. So a good example of this is uh let's say everybody on earth has a crystal ball, and everybody knows for certain that this crystal ball actually does work. And this crystal ball is showing us that the price of, let's see here, let's pull up. Oh, is that working? Window, share. There we go. Let's say the price of SPY um, in 1 year from today will be $800 per share. So we know in 1 year it will absolutely, for certain, there's no chance that this could be wrong. That the price of SPY will be $800 per share, which represents a 17% upside from here. Well, what would happen is as soon as the market opens, or if it was open right now when everybody looked at the crystal ball, the price of SPY would immediately jump to $799.99. Immediately. Because zero people would be willing to sell it for $690. Zero people would be willing to sell it for $740. Zero people would be willing to sell for $790. So the sell orders would immediately all universally become $800 per share. Now, if you're a buyer, you'd be willing to buy at any of those prices because you have a guaranteed profit. And so immediately the price, if any transactions were to happen, would happen between $799.99 and $800. And I'm saying that a little bit stricter. Like, sure, there might be a couple cents, because if it becomes $799.99, somebody might be like, oh, well, I'm willing to sell it there because then I don't have to wait a year to sell it for 1 cent more. And so then you might get a little bit of fluctuation, but virtually within an instant, it would immediately become almost the exact same price as that future price that everybody knew it was going to be. That makes sense because that future guaranteed certainty gets priced into the present. Now, instead, let's say just one person has this crystal ball. Well, if I get that crystal ball and I know for sure it's going to be 800, number one, I'm going to put every single penny that I have into it at any price here. So right now it's 683. Number two, what I'm going to do is I'm going to buy every single call option I can get expiring, the day after 1 year from now. That would be profitable up to that price. Number three, I'm going to use margin on all of my accounts, leveraging up in order to to buy as many shares as I can. Number 4, I'm going to go out and get a home equity line of credit and a home loan and a personal loan and max out my any credit cards. I'll open up a bunch of new credit cards with a 12-month, 18-month introductory 0% rate, load upon all those, and use all that to buy as much as possible. Once I cannot buy anymore, I'm going to call my dad. I'm going to call my mother-in-law. I'm going to call my grandparents. I'm going to call my aunts and uncles. I'm going to call all my friends. And then and then once all of them are in, then I'm going to go on YouTube and I'm going to say, hey, I promise you, this is absolutely guaranteed. Within a couple of days and a couple of weeks, every single person who gets that information from me is also going to be doing the same thing, spreading that. So the price from that alone will start to move. And then eventually it gets priced in by the entire market. And again, back up to 7.99, somewhere in that range. The point of all of this entire example, that markets are future discounting machines, which means the more something is guaranteed to happen in the future, the more it's already priced into the present. Now, if something is not guaranteed, it's just likely, then it's not going to be priced in as much. And you have different things that are potentially priced into the market at the exact same time. And so that's why you have markets that kind of move sideways for a while. The government shutdown, which is the question that I'm answering here from Ed, the government shutdown is guaranteed to happen. And so it is already priced into the market. There is a point in the future in which this government shutdown will end. Now, there could be a lot more volatility on the way if it lasts a lot longer than people expect, but it is guaranteed to happen. And so the vast majority of the effect from that is priced into the market already, which is basically not much. So the end answer is I don't expect much to happen when the government shutdown ends. Maybe a slight little, pop. Okay, let's see here. Questions. All right. So the question there is, what percentage of your total portfolio is Bitcoin? Um, because of when I allocated 5% and then dollar cost averaging in along the way, my allocation is higher than 5%. It's closer to 10%. Um, but that's based on a result of the gains, not a result of the allocation I made with my, for my not my cost basis, basically. All right, let's see here. My crystal ball says food will always be needed, will be need distribution, and tech will be junk for 50 years. Well, I don't know if that counts as a crystal ball, but maybe it counts as an 8 ball. Those old school toys, you shake them and then the answer comes to the top. Right, let's see here. Is day trading viable in your opinion? Yes, if you're a robot. And if you have about 3 years to lose money day trading before you finally figure it out. So if you have a 3-year runway where you know you will lose money for 3 years straight and you are an emotional robot, then day trading is viable. The reason why I say that is because as soon as money is on the line, you have just inherently you will have an emotional attachment reaction to it. And so you can be as strategic and as tactical as possible and have the best plan going in. But once you make once you have a long position or a short position, you're looking at that and you have an exit in mind. Maybe you're even disciplined enough where you do have your exits determined before you enter. And then you enter and you're like, you hit your stop loss exit point and you're like, well, maybe it's going to bounce back. And then you hold on and it turns into a big loss. So if you have any, like personally for me, I do not day trade. I cannot day trade. I'm just far too volatile. Just my neuroticism is too high for me to be able to make rational, non-emotional decisions in the moment that quickly. Longer term trades, swing trading, and then long term investing is a lot easier for me to pull back, set automated orders like limits to get out. And remove my emotions from that decision making process. And so, yeah, with day trading, it's just at least for me, I've never been successful every time I've tried it, and the big reason for that is because I start to execute judgment on each trade rather than using judgment to set up the strategy and then just sticking to the strategy completely. And so you have to be able to completely be non-emotional, and that's a knowing yourself type of thing. And then you also have to spend a good amount of time losing money because your strategy won't work at first. You'll have to figure it out along the way. And I think 99% of people, you're not going to be able to day trade successfully. Let's see. Does passing the CFA test help open the door to finance jobs without any experience? I have an MBA but no investing work experience. That's a good question, and I actually this might have changed in the last couple of years because I know that you can get, like, your Series, 65 or 63, maybe even your Series 7 now without being sponsored from a financial institution that you work for. I don't know if that's the case with the CFA. I think to get your CFA, you might need to already have a job. That might be different, so I might be wrong about that. Um, but I don't think it would help without any experience. Because if you don't have any experience, that part really doesn't matter. They're still gonna have to train you to do the job, which means you're gonna be starting from the bottom anyway, which means, uh, get in the door, and start gaining that experience first rather than spending 3 years trying to get your CFA, maybe 4 years. I know a lot of guys who are way smarter than me, years, and they fail their level 3, 3 times in a row before they finally pass it. Um, and so do all that while you're gaining experience at the same time. Don't put yourself back. It's kind of like I'd liken it to getting a degree where it's like you're like if you go to college, you get a traditional degree, bachelor's degree, or master's degree even or more. It's like you are putting your earning power years on hold in order to accumulate debt. And even if you're not accumulating debt, you're cash flowing it because you're working at the same time. It's like you're still putting yourself behind because otherwise, if you were just working, gaining that experience, you could be saving that entire time and spend it instead of spending all that extra money on a degree that's really not going to provide any competence whatsoever. It's going to be a piece of paper that just tells an employer that somebody else says you might likely have some competence or ability to develop competence in a certain area. So I think, especially in today's day and age, certifications are pieces of paper are a lot less valued than demonstrating competence, and you can only get that with experience. All right, let's see here. Questions. Where do you think we are on precious metals miners? Near the bottom? Well, I don't even know where that question to me kind of sounds a little ridiculous because when you look at GDX, does this look like we are near a bottom? We are way closer to a top than anything that we could be construed as a bottom. Now I know you're probably talking short term here, but I just want to put this in perspective that like in the last since December, so within less than a year, gold miners were up 153%. So to expect that that's just going to continue without any sort of a correction or pullback and volatility and consolidation along the way is just gambling. It's not y- Something like this is very healthy in a bull market. You want to see pullbacks, you want to see corrections, you want to see price consolidation, you want to see establishing new levels of support. Um, those are times, where when that distribution happens, you can accumulate more, you can trade around it. Um, and so this kind of, I mean, it's only been, GDX topped out 2 weeks ago, so it's been 2 weeks. So I don't short term, no, I would not anticipate this to be I would anticipate a lot longer of, volatility and just sideways price action, um, just given how much it takes to move these things, the amount that they've gone so far. All right, let's see here. Questions. Okay. Trying to find some good questions in here. If you guys have questions that you want me to answer, you can throw them in. What do you think about Oscar health? Let's pull up the chart. Full disclosure, I am long Oscar. Really beautiful cup and handle here with a nice breakout. Obviously, this is an incredibly volatile stock. We've got just within a couple of days, it fell 43%. And then within a couple of weeks from there, it was up 82%. Ultimately, just in this nice little breakout here. So, um, very, very volatile stock. You can lose a lot of money really quickly. Um, Over the long term, I am very bullish on a company like Oscar. One of the reasons why is because of the political connections that this company has to the current administration. Um, there are a couple other reasons as well. So I am bullish, technically speaking, fundamentally speaking. Um, Over the long term, short term, this thing can do literally anything. But I like it. Am I from Michigan? No, Arizona. What do I think about commercial real estate? I am not. I'm far from an expert in commercial real estate. I'm not a commercial real estate investor. That being said, I think there's a very good chance that commercial real estate is at or near a bottom. It is. The last couple of years have been very, very, very rough for commercial real estate. It depends on what there's no such thing as just commercial real estate. There's like very little correlation between office space buildings and hospital buildings and self-storage facilities and retail spaces. Um, and so you have to look at each one of those individually. I think there's a good chance that office space still has some rough years ahead. Um, but overall, like, if you are averaging it all together, I think the last couple of years of pain, um, there's there's probably some good opportunities to be found. One of the reasons why we didn't see a big amount of, bank trouble from this really, for years, right after, 2021, everybody was saying, "Hey, these higher interest rates, all these loans are gonna be maturing." 'Cause commercial real estate doesn't do 30-year mortgages, it's like 5-year loans with balloon payments at the end, and everybody was saying, like, the whole thing is gonna collapse. The reason why it didn't is because banks were so overexposed that they just worked with the borrowers on this, and so, um, a lot of the pretty large commercial real estate investors that I was following or that I do follow throughout that time, they of course were worried, and of course, we're looking at this, but it was like, hey, well, if we go under, the banks have trouble. And so they were able to roll over a lot of it. They were able to refinance a lot of it. And so I think probably, especially with interest rates headed down now, I think that the worst of it is most likely across most commercial real estate behind us. Okay, let's see here. Any other questions? The government shutdown's effects on liquidity. One thing is just the lack of deposits that are being made into the banking system. So any money that the government has, it's held in the Treasury General account, which is a bank account that is held directly at the Fed. It is not in the banking system. That wasn't the case prior to the financial crisis. Prior to like 2008, I think in October is when the Fed switched it over because of the QE. They didn't want all of those extra deposits that the government would all that those extra they didn't want that impacting liquidity conditions at all. And so the government's checking account was basically withdrawn from the banking system, and now that bank account, the Treasury General account, is held directly at the Federal Reserve, um, which means that when the government stops making a bunch of payments, their Treasury General account starts skyrocketing and spiking. I think right now it's above 800. Let me see if I can pull it up. Treasury General account. $950 billion. Let me show you guys the chart. Okay, let's do the entire screen. So this is the Treasury General account. This is the government's checking account. This is any money that they take in taxes or that they borrow comes into this account, and then anytime they spend any money, it goes out of this account. Um, so you can see it didn't get used before. Once it became starting to be used, then it was fluctuating around this level. Grew. Then after all the money printing, they like to keep this account around $850 billion is the goal, because every time there's a government shutdown or a debt ceiling dispute or anything like that, um, if they're not able to pull new money in this thing, they just have to start spending this down. And so $850 billion is where they like to keep it. But during times like right now, where it's like um, the payments have stopped, but it's not a like a debt ceiling one, so they're able to continue borrowing, um, and obviously they continue taxing. So this is just flying up way above where it normally would be, and that is money that is not entering the banking system now. And so because it's not entering the banking system, it is impacting liquidity. So that's one of the reasons why we've seen increased usage of the repo facility at the Fed. I don't think it's a big deal. The Fed is obviously going to be paying very close attention to this, and they intervene in the repo market now, like whenever is needed. Um, and so once the government shutdown ends and that money starts getting paid out again in the paychecks and everything like that, it's gonna hit the banking system, and kind of undo all of the short term tightening that it's doing right now. So, um, so over the next couple of months, it's a non issue. Like there's no effect. It'll be a net zero, no effect thing. But right now, it's extra tightening. Once the government shutdown ends, it's a burst of liquidity as all that pent up cash gets spent out. Okay, all right. So the market is closed now. Let's take a look real quick at the chart to see where everything closed, and I'll get back to the questions before we end. All right, so Bitcoin, we're at 106. Gold, we're at 4,000. Oh, we're back above 4,000. That's nice. I expect a lot more consolidation around here, but we'll see. Silver as well. SPX closed at 68.52, which for SPY is 683. So technically speaking, this is a nice bullish setup here. We've got some long wicks on the bottom of these candles. Basically means that selling happened, and then buyers took over, drove it right back up 2 days in a row. We do have this gap here and this gap here that hasn't been filled. So if we do get some surprising negative news, I would not be surprised at all to see this thing just within, basically probably one day pop right back down to even like 67.34, fill that gap. But on the way up here, we've seen multiple gaps that have not been filled. That gap never got filled. This gap never got filled. This gap, maybe you could say did. This gap did not. So the idea that all gaps must always be filled is just not true. It just happens most of the time, especially in this recent bull market since the bear market ended in April, which it was a bear market for anybody who is Curious. Okay. Let's see here. Are there any unusual strategies you use to hedge against unusual edge case threats that have caught your personal attention, like a property with a well in New Zealand to hedge for future water wars? Um, I mean, not really. I don't I don't think there's the problem with anything that sounds creative or fun is like usually there sometimes there's issues with it actually performing and turning out the way that you expected it to, even when the catalyst you were looking for happens. So I tend to like to try and keep things pretty simple. So, for instance, if one was expecting a water shortage, you can buy a water ETF. What's a symbol on a water ETF for you guys? Um, oops, that's wager. Water, water, water. Um, all right. PHO is an Invesco Water Resources ETF. AQWA is a global clean water ETF. PIO is an Invesco global water ETF. So this one is PHO. Uh, let's see. What does this actually invest in? PHO is a water themed fund of US companies that create products that conserve and purify water for homes, businesses, and industries. Okay, so this one probably wouldn't be a good one to hedge against a drought. uh, what was the other one? Aqua. Okay, let's see. What is this one? Provides exposure to global water industry by investing in companies of all capitalization that derive at least 50% of the revenue from either water infrastructure, water equipment, and or services. So this one, AQWA, would probably be a good one. Get some, the options on this are probably super illiquid, just because this volume is crazy low, just on the shares. If this thing has options, oh, that's weird. The volume has just spiked recently. I wonder why. Maybe there was something that happened with the shares. I wonder if they did that might be a data issue, um, because that's a big jump in volume. Either way, the volume on this thing is very low. The volume is a couple thousand shares a day at the low end. So volume is super low. So if it does have options, you're probably looking at the money are the only ones that will have a decent enough bid ask spread. You can go way out of the money, pick as far dates as possible. Just know that you're going to be probably paying close to the ask for it. Um, and then that would be a hedge against some sort of a drought or a famine. Um, so yeah, anyway, I tend to keep things simple. If there's ways to do it in a typical brokerage account, I'm going to do it that way, because the more liquid a market is, the more illiquid a market is, the harder it'll be to be able to capitalize on that, even if what you're expecting to happen happens. But the more liquid something is, the more you'll be able to actually realize those profits. Let's see here. Okay, so from Cody, thank you for the super chat. Did you see the secured overnight funding rate 7.5 billion was used today? I did not see that yet. It doesn't surprise me though, because of what we've been talking about. So reverse repo facility is down to zero. Um, the Fed just announced that in 28 days they're going to have to stop QT because reserves have gotten down from abundant to what they call ample. Um, and so liquidity is a lot tighter in the system than it's been for years. Um, and then we've also seen more and more usage out of the repo facility, the regular repo facility at the Fed, which is where you go when liquidity is tight. And then also with the government shutdown, you have less cash entering the system from them, and more cash is being taken out from them because they're still taxing and they're still borrowing. And so there's short-term tightening going on right now. So it doesn't shock me at all. It doesn't look like anything like crazy or systemic issues or something like of a sign of something worse to come. It's just a sign of what's going on right now. And I don't think there'll be any knock-on effects from it. All right. I thought the QQQ or SMH is going to go down. What's the short stock? If I thought QQQ or SMH is going to go down, what's the short stock? I think if you're asking there, what is the symbol of the inverse fund? The best way to do this is you literally go to Google and you type in NASDAQ ETFs. And the first or one of the first results that you'll get is a website called etfdb.com. It's etfdatabase.com. And it'll just give you the list of all the ETFs that track the NASDAQ index. It'll give you the leveraged ones. It'll give you the inverse ones, which I believe is what your question is about, the inverse funds. The the important thing though is I always say that you should stay away from leveraged and inverse funds like the plague. Um, they're meant for day traders, and by day trade I mean you open and close the same position in the same day. Um, and unless something is in a permanent bear market with very little volatility, an inverse fund is going to be designed to bleed you dry. Unless something is in a permanent bull market with very little volatility, a leverage fund will bleed you dry. You can even have, because of the way that beta slippage works, you can even have a stock that goes up over time and a leverage fund that tracks it will go down over time. I know this might be like a difficult thing to like calculate in your head, but let's say a stock goes down 1%. Now let's say stock goes down 9% and then up 10%. Yeah, that'll be roughly flat. Not 9% down, 10% up. That'll be roughly flat. But if you have a leverage fund that is tracking that, the 9% down is actually 18% down. And then 20%, it'd be 20% up. If you pull out your calculator and you start at 100 and you multiply that by, I wonder if I can show you my calculators so you don't have to pull yours up. Okay. You start at 100%. So if you want to go down by 18%, because that's double the underlying of 9%, you're going to go multiply that by 0.82, and you're going to be left with 82 after that 18% down. And then now you're going to go up 20%. So you go times 1.2. Now you're back up to 98.4. So even though the index that you're following is back up to break even, because look, the index you're following is 0.91. So that's 9% down times 1.1, 10% up. You're a little bit up. So the underlying, if it does this every day, 9% down, 10% up, 9% down, 10% up, slowly but surely it'll track up a little bit. But the leveraged fund that follows that just with double the leverage, 100 times 0.82 times 1.2, it only gets back up to 98.4% of its original value every time it does that round trip. So the leverage fund will actually trail down over time. This is why leverage is so dangerous because that's called beta slippage, because losses are more powerful than gains. And so even if you have the underlying do well, if you're tracking with a leverage fund, you might still lose money. So I don't think you should touch them with a 10-foot pole. All right. Would it be smart to refinance a house now before rates start to rise again? A friend has a mortgage over 7% now and has the opportunity to refinance at 5.9. Mortgage is 320. Closing would be 10K. I can't do the head math here on how long it would be before break even there. If the cost is 10,000, how much is he saving each month? And how long would it be before he gets that $10,000 back in terms of the savings rate? If it's a really long time, might be worth waiting. If it's pretty close, then might be worth doing right now. I think mortgage rates for a period of time will go lower before they go higher. But yeah, I mean, 1.1%, that's not a huge difference. So that might take a long time to break even on 10,000. All right, let's see here. Next question. Under what conditions will the Fed restart QE? I think they must help inflate the debt away, but do you think they'll wait for an excuse um, or a crash before starting? The Fed almost never cares about a stock market crash. Like the last time that they were like somewhat influenced by the stock market crashing was obviously 2020. But even then, it wasn't like just a stock market. It was, government shuts everything down. Everybody runs out of money immediately. um, and then the time before that was end of 2018 when they were tightening, raising rates, and then the market started to crash. And there was no inflation from the metrics that they were watching, and so they were like, "We don't have any justification to continue doing this." So that's when they stopped doing QT. They've already announced the end to QT. Um, the thing that would make them start QE again is excessive usage of the repo facility, meaning that liquidity is just too tight. And $2 trillion government deficits mean that's going to happen. It's a matter of when, not if. So I don't think it'll be this year, but will it be quarter 1 next year? Probably. And it will be very small. They're not going to be doing, unless some crazy thing happens. If everything just keeps on going the direction it's going right now, it'll just be slight increase to their balance sheet. So right now, I think they stopped the runoff of their balance sheet at like 6.5 trillion. So they might just add like basically increasing it even at a slower pace than they were decreasing it, just enough to kind of to keep a little bit of grease running in the machine. Um, Meet Kevin said I'm a fraud. Meet Kevin knows who I am. Cool. Um, Interesting. If you guys know what he said, why he said that, let me know. Or find the clip. I'm really interested why he said that. Um, let's see here. Kirk Fashy, you say a fraud calling a fraud a fraud. Why do you think I'm a fraud? Let me know. I thought you had the crystal ball. That's why I subbed to you and 50 other finance YouTubers who have proven to be full of unicorn farts. You followed people because you thought they knew the future and they could tell you what asset prices were going to do in the future. Interesting. Okay. That makes sense. If you are following people around because you think that they can tell the future, then you're going to be disappointed a lot. All right, let's see here. My wife's boyfriend said I should invest in healthcare stocks because Trump is going to. My wife's boyfriend is going to obliterate Obamacare. I don't think Trump is going to obliterate Obamacare. Yeah, I don't think that at all. Um, we'll see though. That would be cool. We don't. There's been no. There was the closest that we got to that happened during his first term. We didn't get anywhere near it. And I don't think there's any chance anything like that happens now. There's too much money being made in that grift, who put the people in power to keep it that way. So, all right, let's see here. I am live. Yep. All right, let's see here. Hershey is a great educator. I always us my own analysis. No, I'm just making fun of the typos there. I know you didn't mean to type that, but it is an important point. Hershey, I get my naming. If you ever start a channel or ever start a business, naming is one of those things I think people overthink way too much. Um, if I could go back and do it differently, I would use my personal name. The reason why is because nobody knows or remembers words for names until you become a $1 trillion brand, but they do remember people's names. It's just the way that our brains operate. Um, Especially if the name is in your own language, it's a familiar word. So my channel is heresy. So heresy is an old religious word that means essentially an opinion that is opposed to the current prevailing thought. And so, like, the classic example is like Galileo was labeled a heretic by the church for saying that the earth went around the sun and not the other way around. And so, many times throughout history, people who have been labeled a heretic, even if it's not used that word, the people who've been labeled heretics by the establishment that is in power eventually later are proven to be correct. And so when I started my YouTube channel, I was thinking, hey, I'm talking about stuff that, when I was a stockbroker, people, laughed at me for my opinions, or worse, I was not allowed to talk to clients about them. The only thing gold was good for was throwing it through a window when when all the power went out from a nuclear apocalypse, so you could go in and get food. It's like, so anyway, the things that I was teaching people about how the economy works and how to invest, I felt like I was looked at as a heretic by the financial establishment. And so that is why I named my channel Heresy Financial. But it's a word that nobody knows or uses today. And so I think that was a mistake. I should have just gone with my own name. But anyway. All right, let's see here. Are you streaming from your dad's addict? My dad does not have any addicts. He's not addicted to anything, and he doesn't have anybody who's addicted to anything. So, no, I'm not streaming from my dad's addict. All right, let's see here. Uh, but you share a name with that black TV judge, so that's confusing. Yeah, that's the reason why I didn't do it. Um, and I don't think he does anything anymore. Um, I don't think Judge Joe Brown is. I think only like Gen X and above knows who Judge Joe Brown is anymore. What do you think of Berkshire Hathaway? Oh my gosh. I am loving the discount on Berkshire Hathaway right now. I know that Warren Buffett's getting to the end of his life here. Charlie Munger's already gone, unfortunately. And so the future of Berkshire Hathaway is like, a big question mark. But man, any time throughout Berkshire Hathaway's history when they've been severely underperforming, and B, people have been saying they're done, they're old school, they don't know what they're doing anymore. We're in a new age, like, that is like the time when you're like, all right, time to bounce on some Berkshire Hathaway shares. So I'm loving the discount. It's a large holding of mine, and I'm accumulating more and more while the price is low. So long term, I'm very bullish on Berkshire Hathaway. I've been watching you for 4 years or so, learned a ton. Much appreciated for all you shared. Thank you. I appreciate that. Let's see here. Are you following the silver situation? What do you think has been influencing the silver prices lately? Silver shortage. Are banks dumping paper silver to prevent being liquidated? Yeah, there's a shortage of silver metal. Lots of standing for delivery. Um, Dumping paper doesn't do anything when there's a lot of deliveries being requested. Um, so I'm bullish on silver. I don't think it's gonna, quadruple or anything from here. At least not in the short term. But a nice pullback like we're seeing right now is healthy in a long-term bull market. 80% cash, 20% assets. Oof, that's rough. Good luck with the inflation there. All right, what do you think of Peter Schiff predicting 17 of our last 3 recessions? Yeah, I mean, that's one of the things that's really easy to do when you start. I know he's been doing this for a long time, so I'm not saying this is him. But when you start learning about how the economy works and you see it's kind of all held together with bubble gum and band-aids and rubber bands and paper or popsicle sticks, it's like, man, this thing looks like it's about to collapse. Um, and it doesn't take into account the full picture, I don't think. And I think that's part of where Peter Schiff has gotten stuck. Obviously, he's doing very well for himself, and it doesn't matter. Like, he's got a bunch of really successful businesses, and he's a great investor, and he's very wealthy. And so what he's doing works. From a business standpoint, from a marketing standpoint, getting clients and getting customers, it absolutely works. And so he's doing well. Don't think it really matters if you're continually predicting doom and gloom if it never comes true. Um, because every once in a while it does come true. It's like, 2020 and 2021 happens, and it's like you can say I was right. Um, it Following that advice specifically though, like from an investor standpoint, um, it's like the old adage of pessimists suffer so that someday that they can be right. Optimists suffer and someday they get to be rich. And that doesn't mean that you have to look at everything as, just standard economic advice and, financial advice and just go with the flow and put your head in the sand and pretend everything is okay. It just means that there's always opportunities to make money. There's no such thing as a world that we can live in. If humans are alive, there's an opportunity to make money. End of story. And so looking at the world through a pessimistic lens puts you in fear or, fight or flight, panic mode, and you're not looking for opportunities. You're looking for ways to survive. Um, Looking at the world with rose colored lenses and trying to find opportunities to make money, you are likely to find that. And There's definitely going to be suffering along the way, but I think it's going to work out better for you in the end. Picture in the background. Watch the replay. I talked about it in the beginning. Don't want to repeat that for anybody who's been here the whole time. Okay, let's see here. Did you buy the dip on gold? My gold holdings, in terms of my main gold holdings, I look at that as savings, and so I don't sell that. I don't buy the dip on that. I just dollar cost average. So I've got my 20% ish in gold, and I just hold it because that's my savings, and I'll use that every now and then if it becomes way off balanced, to buy things that are on sale. Um, so I'll do that from a rebalancing perspective, but not price action specifically or exclusively on gold. I do trade gold in my trading account. I'll do calls and puts on GLD, on GDX, and I closed out my calls on GLD for a really nice profit with a couple of weeks ago. I'm sitting on some good gains on my puts on GLD right now. Haven't closed them out yet to put it back into a long position for my trading account, but we're probably pretty close. All right, let's see here. It's funny you say holding cash, good luck with the inflation, and then you say you're big on Berkshire. Meanwhile, Buffett holds record high cash pile. Buy assets, get wrecked with optimism when bubble pops. Yeah, that's true. The difference is that Buffett is not an anonymous internet person. Um, He's got a pretty good track record. So if you're holding an equal percentage allocation to cash, I don't think Berkshire Hathaway has 80% of their money in cash, by the way. I think it's a little bit less than 80%. And I don't think it's in cash. I think it's in T-bills, which is pretty close to the inflation rate. Um, and it's got a pretty good track record with being able to buy businesses on sale and timing that. I think they're, for a portion of a portfolio, pretty trustworthy to outsource some of that too. All right, let's see here. Yeah, no, I'm not betting against Buffett. Buffett is uh, got a really good track record, and I really like Berkshire Hathaway. Let's see here. Questions. All right, last two questions here. Thank you for the super chat, Steve. Enjoying the live market close. Looking forward to seeing a future collaboration with Jack at Nobody Special Finance. That's actually, is that tomorrow? I think tomorrow I'm going on his show, and we're going to be talking about liquidity and stuff. So if you guys follow Jack, I don't know if we're doing it live or if it's recorded and posted after, but I am going to be going on Jack's show tomorrow, I think. So thank you for that. And then appreciate the super chat. Jack, question: how do you decide on high risk, high reward positions? Math. All right. So this is important because a lot of analysis stops at, okay, yes, I'm bullish, or yes, I'm bearish on this position. So let me pull up a chart here so you can see what I mean by this. All right. So let's say you're expecting, SPY to reach the top of this channel, and then it's going to bounce back and hit the bottom of this channel. So you've got a from this current spot, you think maybe a 5% drawdown on SPY. So that's not enough. And maybe you've got really high conviction with this because maybe, you're looking at the RSI, it's extremely overbought. You're looking at margin balances and everything. Everybody's extremely over leveraging. You're looking at hedge fund positioning, and everybody is extremely overexposed to equities, underexposed to bonds. But you're looking at everything in the market right now, and you're like, oh man, we are due for a pullback. Volatility is super low and suppressed. You're like, all right, we're going to get a 5% pullback, hit some, maybe there's, some good support there, something like that. That is still not enough to be able to make a trading decision on. You need to know whether or not your position would be profitable if what you expect to happen happens. So what you have to do then is you have to go in and you have to look at, okay, let's say I'm going to buy the 670 puts, and I expect this to happen within the next 3 months. The 670 puts, let's say they cost, and I'm just making this up right here, so please don't think that these are real numbers. I'm just purely making this up because I don't have the chains in front of me. If you're going to buy the 670 put, let's say it costs $10 and those expire in 3 months. Well, if nothing happens, you expire worthless. So your total potential loss is 100%. As long as you keep your position sizing small, that's not going to be an issue on your portfolio. But you could lose 100%. And if it does nothing, or if it just comes down a little bit and then goes up from there. If it does go all the way down to 660, then you break even by expiration. It drops from 683 down to 660 because by expiration, the only thing left is intrinsic value. That's going to be $10 at that time. You spent $10 on it, so it expires at 660. That's your break even point. So you didn't make any money, but you get all the money back that you spent on it, so you break even. Best case scenario in terms of your analysis is it comes down to like 650. And so if it hits 650 by expiration, that contract will be worth $20. So you're risking $10 for the chance to make $20. So your profit potential is 100%. You're risking 100% to gain 100%. Now, technically speaking, that is not an asymmetric trade because the amount you could lose is the exact same as the amount you could gain, which means if you're just flipping a coin and you make that trade every time and it's just a coin toss on whether or not it works out, that means you never make money. And with trading fees and taxes, you slowly lose money. So you need your profit, your best case scenario to be at least better than your potential worst case scenario. And then it might be worth it for you to take that trade. But you have to actually do the math to see, like, you can't just say I'm bearish, therefore puts, and I hope I make money. You have to see, okay, well, if I'm right, where could it go to, and am I going to make enough given the risk that I'm taking on? And you have to do that for any investment, any trade that you make. Like, if you're long-term investing, you're like, okay, margin of safety here. I think, worst case scenario, I could lose 20% if the company files for bankruptcy and they just have to give all the money back to shareholders. That's a pretty good downside risk. That max I could lose is 20%. Well, you're looking at this company, you're like, okay, well, over the next 10 years, like best case scenario, maybe I make, a 30% return. It's like, oh, that's probably not that great either. Maybe it's probably, even though the risk is low, maybe the reward isn't worth it either. So that part, whether it's worth it or not for you, is up to you, depending on your strategy and your consistency with your strategy. And are you doing this in the trading part of your portfolio or the long-term investing part of your portfolio? But you actually have to look at what the numbers are, look at what the math is in order to even start to make a decision on whether it fits in with your overall strategy. Okay. That's all. Really appreciate all the questions. You guys had a lot of good questions today. Fun to answer. I'm going to be doing these lives as much as possible. Most of the questions I see coming in towards the end, I've talked about in the beginning. So this will be going up as a recording. You guys can go watch that after. And normally these live streams, when I do them, I'll be doing them around the market close time. So if you're looking out for that later, it'll be around the market close. So thanks so much. Appreciate it. We'll see you guys next time.